Hi, and welcome back to Investor Day here with ABG and Introduce. My name is Victor Kruger. I'm a real estate analyst for the equity team here at ABG. Our next company to present is Stendorren, Fastigheter, and with us we have the CEO Erik Ranje and CFO Per-Henrik Karlsson. So with that, I'll leave the word over to you guys.
Okay, thank you very much. Again, yes, my name is Erik Ranje and I'm the CEO of Stendorren since 2 years ago. Yeah.
Yes, Per-Henrik Karlsson, CFO at Stendorren. I've worked with Stendorren for about 3 years now.
So if we jump into the presentation, basically we are a listed real estate growth company. We focus on light industrial, warehouse and logistics, and our property portfolio is located in the growth area in Sweden, i.e. the greater Stockholm region. We also, as you may have seen in the press release today, we also do residential. We, within our existing property portfolio, we rezone land into residential for the purpose of further development and keeping it under management. And that is a business model that works very well in our most urban areas. You could say that Stendorren has a market opportunity in the sense that we are a derivative on a few macro trends. One is urbanization. A large part of our property portfolio is located in the greater Stockholm region. But also another macro trend is e-commerce, which obviously generates a very high demand on logistics assets, and a relevant part of our property portfolio is logistics, and in particular when it comes to our development portfolio. So we keep under management, we develop and we buy real estate within light industrial logistics and warehouse. If we go to the next page here, a few data points on Stendorren. We have a property portfolio of around 11.7 billion, so it's a relatively small listed company. Market cap slightly less than 7 billion SEK. We have a yield of 5.6%, i.e. we are in an asset class with relatively high yield, and we have long lease duration. On average, remaining lease duration is 3.7 years, so it's high yielding, long leases, i.e. very stable cash flow, and that paired with LTV below 50% gives a lot of stability. But we also perceive ourselves as a growth company. We have standing asset around 790,000 square meters, but we have in relation to that a very large building rights portfolio of around 650,000 square meters, so some 80% more. I will skip the next page in the interest of time here. The background of Stendorren. Stendorren was founded 2014 as a carve out from Kvalitena and put under separate management and listed on the stock exchange, First North at that point in time. Stendorren has always been a growth company. The growth has been almost exclusively acquisition driven. We continue that acquisition-driven growth journey, and we are actually accelerating it because, as you may have seen, we have added new markets. We entered into Copenhagen last year and also Oslo. We also made a few acquisitions in Borås, west of Sweden. So we're adding more hunting ground, you could say, to accelerate growth. And in addition to that, we also have accelerated our building rights or development activities. We have submitted a large number and also obtained a large number of building permits. So that's a bit of the background. The business model and what we do to sort of capitalize on the potential in Stendorren. We have, as I said, initially a very stable cash flow as a result of the fact that we are in the high-yielding logistics, light industrial, and warehouse segment. Long leases, but we also have a sustainable growth potential. The fact that we have a large part of our property portfolio in urban areas, 1/3 is in the Stockholm municipality, where land is scarce. There we have an increasing demand of square meters from tenants, but at the same time, there is a conversion potential into residential, which means that the number of square meters in our sector in urban areas is, if not decreasing, at least not increasing. And if demand increases and supply does not increase or even decrease, then rent increases a lot. And if you look in our latest quarterly report, you will see that on average, we, upon renegotiation of leases at maturity, increases the rents with roughly 25%. So there is an embedded lease growth potential in our asset class, in our location, i.e. urban areas. We generally see high increasing demand for logistics space, both in urban areas but outside of urban areas. That is very much e-commerce driven. I've seen different statistics on this, but around $1 billion of US sales e-commerce requires 1 million square feet of logistic space. And that is approximately 3 times more logistic space than traditional retail needs. So the growth, but also the migration into e-commerce generates need for logistics square meters. And then obviously, if we talk about growth, we are continuing to buy properties. We have a very value accretive acquisition model where we buy properties off market, basically property by property, where we can acquire properties at, in our opinion, a lot higher yield than would have been the case had it been a larger portfolio in a competitive auction. An additional source of growth is, as I've said, the building rights portfolio, 650,000 square meters, very much within logistics, light industrial, but also residential. If you go a little bit more into the detail when it comes to our portfolio, the stability of the cash flow, approximately 2/3 of our property portfolio is within light industrial and logistics and warehouse. 1/3 of the portfolio is within the Stockholm municipality, i.e. urban areas. 1/3 is in greater Stockholm area, and an additional third is in Mälardalen, which for those of you who are not Swedes is the, let's say, the greater Stockholm area then. In a high yielding segment. The lease profile is very granulated as well. Our largest tenant is around 10% of the lease cash flow, and that is Coop Logistics within groceries, which is basically retail, grocery retail. We have tenants from engineering, such as Alfa Laval, medtech, such as Bactiguard. We have also some municipality tenants, Nacka Vatten and also Uppsala Vatten. So we have a very granulated and diversified tenant base with some 800 tenants, and the lease profile is fairly evenly distributed over time. If we go into the growth, I will keep this very short because this is sort of, all of this, but the Stockholm region is growing regardless of if you measure it by GDP, population, consumer spending, GDP per capita. We are located in growth region. And secondly, we have an exposure towards e-commerce in the sense that both within our existing property portfolio, but more in particular within our development portfolio, we have logistics potential. We will go into that a little bit further on. Actually, we can go to that straight away. Here, this is an overview of our development portfolio. As you can see, this is future projects. We have in total 650,000 square meters of building rights in comparison to the 790,000 square meters of standing asset, and most of it is zoned land already. It's basically just to submit a building permit application. There are some projects that may require rezoning or that will require rezoning over time, but mostly it is in good locations, in reasonably urban areas, already zoned land for industrial use. Our existing project pipeline, we have some 40,000 square meters, which we are working on a daily basis, so to say. Most of it are projects for which we have already obtained building permit. And it's both within logistics, light industrial, and residential. We, as I said, sent a press release this morning that we have received building permit for our first residential project. That is the first stage of this project that you see on the screen. I think it was 326 apartments. And this is a very good example of the industrial logic or link between what we do within light industrial, warehouse and logistics on one side, but also residential on the other side, because it's obviously very different asset classes. But here, this was an asset that we acquired 2016 as a yielding asset, but with a very low plot ratio, i.e. large land plot, relatively small building, we can erect more buildings on the spot. We drove rezoning project, and the residential buildings that you see around here it's just empty land right now. So these are illustrations or renderings to show what it will look like. But this is a very typical example of how we can use change the use into something more valuable, i.e. residential on land plots with a low plot ratio. A few words on sustainability. We are right now working on a new sustainability strategy. Will be presented in the annual report end April, and it will contain a little bit more of the same, but with a little bit higher ambition. But nonetheless, we're proud of the fact that under the existing sustainability strategy, we have accomplished quite, in my opinion, impressive things, reducing the CO2 emission per square meter with more than 50%. We have decreased energy intensity by square meter again, so it's comparable, and also migrated over time into more renewable energy sources. As a first slide on the financial part of this presentation, some data points on the full year 2021. Within asset management, we implemented some change, primarily on the letting side, end 2020, which basically gave a strong effect already. We changed the way we worked in a very fundamental way to improve the letting activity, and that again had an immediate effect. We are very proud of the development on the letting side, where we have had net letting of 40 million during 2021, and unfortunately our second largest tenant went bankrupt second quarter 2021, and had that not happened, the net letting would have been 57%. This is nonetheless a result of implemented changes, a new way of working, which means that this is a sustainable improvement and not one-offs, in my opinion. Again, I mentioned the fact that the combination of our asset class located in urban areas or in growth regions gives a very strong rent potential. On average, during 2021, renegotiated leases gave us an increase on those leases with an average of 22%, which is a very strong figure. And also that is an underlying trend or an embedded growth component in our portfolio. So that's, in my opinion, also sustainable. Within the development side, we have since let's say 18 months gone through and analyzed on a property by property basis the full property portfolio, which we have found quite a large number of very attractive projects. We have submitted 6 applications during 2021, and we obtained 3 building permits during 2021. And another one, or actually yesterday, one more, and I think it was end January one as well. So yeah, that's on the development side, strong progress as well. On acquisition side, we made 11 acquisitions during 2021, worth 750 million. 3 of them were in Denmark during 2021. Then we made another acquisition early 2022 in Denmark, Copenhagen. We also made an acquisition in Oslo, and we expanded into west of Sweden, i.e. Borås, Viared. So strong achievements there. Also off-market deals at attractive yield levels. And all this has fueled through in our financials, as you can see, with quite strong performance on both net letting, return on equity, and net asset value growth.
Yes. Next slide is our financial year 2021, and we had a strong financial year with a rental income of 653 million, NOI of 488 million, and a net profit of 1.2 billion, LTV of 46%, and equity ratio of 43%. And also, as we mentioned before, a property value of 11.7 billion. Next slide is some financial key metrics. Up to the left, you can see our property value, and we are growing property portfolio, both in number of properties, but also when it comes to value. We have a stable and improving ICR, and it was 3.0 at year end. Down to the left, we have property from property management, also increasing and more stable since Q1 2020, and was for the full year 267 million. And we have a strong balance sheet, solid balance sheet, an equity ratio of 43%, as I mentioned before. Next slide is our net income walk, where we start our walk at the rental value of 734 million, vacancy worth 81 million, and other income of 3 million, which gives us the total income of 656 million. Property expenses of 168 gives us an NOI of 488 for full year, and then central admin 77 million, and financing costs of 144, which then will be leads to the profit of property management for 267. We also had the value changes of about almost 1.3 billion, mainly the properties, but also our derivatives. And then taxes, mainly deferred taxes of 313, which then ends up on our net income of a little bit more than 1.2 billion. Next slide is our debt funding. We had at year end a total interest-bearing debt of 5.6 billion, of which is 4.3 is secured bank debt and 1.3 billion is senior unsecured bonds. And we use several of the leading Nordic banks for our financing and approximately 60% on acquisitions. We also have a hybrid bond of 800 million. So if we look at the graph to the left, 68% of our total debt funding is secured bank debt, 20% is our senior unsecured bonds, and then 12% is our hybrid bond. When it comes to loan maturity, we can see in the graph in the middle that we have a good spread on a maturity profile. We have average loan to maturity of 2.4 years and an average interest rate of 1.9%. And also, if we include our interest caps and swaps, the average interest fixing is 3.7 years at year end. Next slide is our share value. We've had this graph starts at 2018, and as you can see, we have increasing share price, but also increasing equity and NAV. But this, of course, after year end, some things has happened also with the share price. Next slide, I will go shortly on this. This is our top 10 shareholders, and to the right you see our share price development. The final slide is our assessed earnings capacity. Our assessment is as of Q4 2021, for a rolling 12-month basis, our total rental income will be 705 million, and our property cost will be about 158 million, which gives us an expected NOI of 547 million. Thank you.
Thank you. Thank you both. You have one of your financial goals is to grow your NAV by 15% at least annually per year. Could you break that down a bit more in terms of cash flow, leverage, project, etc., where you see that this growth will stem from?
I think it will primarily come from the development portfolio. But I mean, if we say that on an annual basis, our renegotiated leases increase with 25%. Obviously, that is the ones that are renegotiated during the year, which is obviously not the full all leases, but especially considering that we have an average lease duration of 3.7 years approximately, then obviously the 25%. We will not have a sort of huge effect each and every year. And then on acquisition, we do off-market deals, tend to be relatively small deals. So it's difficult to build scale and volume by doing that. So I think the largest potential is by far the development portfolio. And that's a good thing because we have the building rights portfolio already, and land is the most scarce resource in our business. So we already have the scarce resources just to get going, basically. And it's already zoned land to the largest extent in very good locations.
Yeah.
So from the development portfolio, basically.
And you had around 250 million invested in existing properties in 2021. How much on average was into projects and how much was into tenant adjustments?
Since we basically started going through our property portfolio some 18 months ago, we have not been in a, let's say, capital intensive execution phase yet. So most of it is tenant improvement and, let's say, general real estate investments. But once we get into more an execution phase, and with that I mean erecting buildings, then it starts to obviously consume capital. So that's ahead of us.
Is that ahead of us by half a year, or do you think it's 2 years ahead? Or?
No, we are. I mean, it depends on what kind of volumes you mean, but we have started to build a couple of our logistics and light industrial assets already in 4 locations already. We are up and building, so it's happening as we speak. Hopefully,
I'm sure. And if we just look a bit to the other markets as well, as you've expanded into recently, Denmark and Norway, how would you explain the differences, the main differences in those markets compared to what you have in Sweden?
I mean, what we like is where our asset class and location meets. It is light industrial, logistics and warehouse in reasonably urban locations. So we want to have the same, we want to have that commercial dynamics, you could say. We want to have, we like the asset class, we like the micro location. We just changed the macro, i.e. Oslo and Copenhagen, but we want to have more of the same. And then adding more hunting ground. So in that sense, the rationale is not different from what we have done in Stockholm and Sweden. However, the market dynamics is a little bit different. It's faster in Oslo, for example. It's more difficult to chase or to get volumes to buy there. It has been obviously easier in Copenhagen since we have made 4 acquisitions already. I think the total purchase price is just below 250 million SEK in Copenhagen.
And do you view the outlook for those two countries? How do you view the outlook for those two countries?
I mean, we hadn't made the first acquisitions unless we thought that we could build critical mass within a reasonable time frame. So that is our aim, to build a reasonably sizable portfolio in each of those markets.
And establish an organization there too?
Yeah, well, if you go through all the leases, you would see that they have both been fully let on long leases, and in general there is a lot of responsibility lies on the tenant, which means that we have bought fairly asset management light properties. But over time, yes, we need to have an organization there. But now we have arranged it in another way. We basically outsourced it. But then again, they are asset management light.
And just the last question, you mentioned a few times during the presentation how you can rent how you can raise your existing rents on renegotiations by around 20%. You did on average in 2021, and you sounded quite optimistic on the outlook for the coming years due to the demand situation or the demand supply.
That is hopefully a result of that we have done a very good job, but it's also a result of that is characteristics which lies within this asset class and these kinds of locations. So that's sustainable. What we have done, we have made some changes on the letting side, as I mentioned. I think one part of them is that we really go through each and every lease that matures within the next 12 months and compare it to what can be achieved upon a renegotiation. And we put a red flag on that particular lease. So we really have made an assessment on each and every lease that's maturing within the next 12 months to really push rents to the right level.
Okay.
And that's the same thing that we have done with the property portfolio to find more projects. We have the head of asset management, head of development, myself, and a few others, the property manager, of course, have gone through each and every property twice to find properties with low plot ratios, where can we knock buildings down and build something more valuable. Really have a business plan session on each and every property, and that is what we see in the project pipeline here. So it's just nitty-gritty work.
That's good. And for the ones that you flag, you mean that you pinpoint the ones out that have the lowest rent, and then you will try to renegotiate them next?
Yes, exactly.
Yep.
So.
Clear. All right. That's our presentation for today. Thank you for being with us.
Thank you very much.
Thank you.